Good morning. It's Sunday morning, ladies and gentlemen, and we're going to be talking today about how doctors and other high income earners can better utilize their funds to pay off their mortgages and student loans and have more money to invest long term. Oh my goodness. Some people think because doctors, lawyers, and other high income earners, because they make so much money, they don't have to budget. They don't have to look at how much money they're making. They don't have these problems that the rest of us do. Well, let me tell you something. It's not how much money you make, it's how much money you can keep. And so what we're going to talk about today is zero in on how we can help high income earners turn what they're making into more net worth. Are you ready for doctors pay off all of your mortgages and student loans in about 7 years? Are you ready for it? Let's go. Good morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. For 19 years, we've been talking about this subject and different things that surround this subject. P.I.L.L Method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. Oh, I see Jerome Pemberton in here today. Good morning to you, Jerome. Hey, listen, Jerome, if you want to get in on this conversation, you're more than welcome. This conversation is open to everyone. And I know in what you do, you deal with high income earners as well. So listen, let's get everybody in here who wants to talk about this subject today, because it is something of importance. We tend not to help those who are high income earners because we feel they don't need it. Oh, that is a mistake. High income earners need our help from the P.I.L.L Method as well, and they deserve to know the truth about their money. You see, all of us, no matter how much money we make, are part of a system that uses debt so that we can buy houses, buy education, especially these student loans. Oh my gosh, to get a car. All of us use debt to get along in life, but we need to learn how to use it more strategically. Because listen, the people who lend money, they don't manufacture anything, they don't make anything. They're not inventing anything that makes our lives better. Here's the thing. Here's what they do. They have money, and what they're trying to do is rent their money. When I say rent, they're actually putting it out there so that we can use their money and pay them interest. Interest is nothing more than rent. So they're putting it out there so that we can rent their money for as long as they can rent it, for as much as they can rent it. And therefore, there's very little information out there that strategically that's going to help us borrow money at a discount. Therefore, we would have more money to invest. We would have more money to do things with, to create memories with us and our children. We have more money to buy more for less. What do I mean? How do we put ourselves in a position where we can create generational wealth, by cutting back on the amount of interest we're actually paying. Oh man, this is a game changer for high income earners. It is, listen, I've got some notes here that I'm getting ready to pull up. Okay. So I want to get this on my screen. Well, no, not it's not on the screen yet. It's not on the screen yet. So I'm pulling it up now. Let me see here. So we can get that over to here. And let me see. I'm going to save it. I'm going to save it as a PDF. Save it as a PDF. And then I can move it on over to our other screen. There it is. All right. It's exporting now. So we're going to be able to pull that up so that you guys can see this. It's going to be amazing. All right. And let me see that it come over. Did it come over right? Yeah, it came on over. How about that? So let's start here. And then we'll be able to bring up some other things. Okay. Doctors pay off all debt. Okay. That's the student loans and credit cards and their mortgage. Do you know that some people, because we are good at what we do, listen, if you're a doctor and you're the best doctor, I mean, the best cardiologist, whatever your specialty is, you're the best at it, and you're a high income earner. What we haven't had time or even the opportunity to understand the money that we're actually making and the system we're all embroiled in. So we're in this system, but all of us, we are a natural resource for bankers to make money off of. Now, some of us do really well. We have high limit, low interest credit cards. We can pay cash for a lot of stuff because we have it. All right. And I'm saying we as if I'm a doctor. I'm not. I'm just trying to get the information out there. So we have this, we have that. We have a lot of things going on that we have, and we have investments. We already have money in investments. Okay. But here's what we're not looking at. We're not looking at how much interest we're actually paying on these debts. We're not looking at that at all. So, so let's take a look at what we can do to maximize our interest savings so that we can pay off debt cheaper. And if we pay it off cheaper, meaning we pay less interest, we can actually pay it off faster and be completely debt-free if that's your goal in 7 to 9 years. But because we have these student loans that in some cases are as much as a mortgage, it tends to slow us down because we don't know that all these student loans, that P.I.L.L method clients can pay off student loans in an average of 5 to 7 years. Don, I had my student loans for, listen, I have been 10 years out of residency and I still have these student loans. Okay. It's a payment I can afford, but they just don't seem to go away. Well, there's a reason why they just don't go away. It's because of all the interest that's being charged that you don't have to pay. So, Don, am I hearing you right? The interest that they're charging, I can use my current budget, pay less interest, pay the loans off faster, and I don't have to sacrifice lifestyle. I can still have a good time with my family. We can still go on vacation. We can still go out to eat. We can still live at the lifestyle that I'm used to and pay the loans off cheaper and faster and still invest in our future. You can do it all with the P.I.L.L method. You could do it all with the P.I.L.L method. So here's one thing that we need to understand when we're doing that. Here's the first thing. We need to optimize interest savings. Optimize interest savings. So I'm going to pull up on my other screen some things that we can take a look at so that we can get this done. So we can show you some great examples. Okay, optimize interest savings. So prevent the law of diminishing returns. Prevent law of diminishing returns. So what we want to do is so that we can keep from putting too much money in one place and not get the benefit of putting money in another place. Focusing on interest saving maximizes the funds available for investments rather than diminishing potential returns. So some of us get so focused in one area. We want to pay off the debt. Okay. And I've told this story before, and maybe this makes sense even now for some of you. Okay. So I have a friend that's an engineer. He's on our program, and he's making more money now than he was when he first started our program. Okay. But with that extra money he's putting into the program, our artificially intelligent opportunity cost calculator that takes this money and says, this is what you can do, and here's your results. Okay. The program itself, the program just by itself takes numbers and then calculates on the numbers. Okay. But you need to understand what you're really looking at. And this is why we provide all of our clients coaching. So to prevent tunnel vision, and here's the tunnel vision, making more money now. And because of making more money, he's telling the program he's making more money. And the program is then saying, you can now be out of debt. You still owe $263,000 on your mortgage. You can now be out of debt in 3.5 years because of the money that you're making now. But our program will also tell you how much interest you have left to pay. Now, people are in the P.I.L.L method. They love the amount of interest of, like in this particular case, $275,000 in interest that this engineer will not pay. $275,000. That is a huge amount of interest that they won't pay. Okay, but it'll also tell you how much interest you have left to pay on the debt that you have. On $263,000, he's only going to pay $16,000 in interest and be out of debt in 3.5 years. When he put that information in and he got those readouts and he came back to tell me, he was so happy that he's going to be out of debt in 3.5 years. But he was kind of taken aback when I told him, you're paying the house off too fast and you're not paying enough interest. What? Yeah. You're paying the house off too fast and you're not paying enough interest. So what did I mean by that? I said it that way to get his attention. So I said, now tell your program the opportunity cost calculator. All right. And I'll bring it up on another screen so you guys can, take a look at what the whole thing looks like. Okay. What you want to do is tell the program you're making $2,000 a month less than you actually are. Okay. You're making $2,000 a month less than you actually are. And then the program will recalculate. So let's take a look at what happened with the recalculations. When he did that, the program told them, now you're going to be out of debt in 6.5 years, and you're going to pay $20,000 in interest instead of $16,000. He says, Don, why is that better? I'm doubling when I'm going to be out of debt, and it's going to cost me more money in interest. And I thought the whole point of the program was to pay as little interest as possible. Well, the point of the program is to optimize interest savings, to save the most amount of interest that makes sense for you. What does that mean? Okay. So now we're taking a look at that. And he says, I don't know if I like that idea. I said, it sounds like you want to be out of debt in 3.5 years. He says, well, yeah, I do. I said, well, why? He says, because we want to build our dream home. I said, let me show you something. Now, what would you have to do what would you have to do to tell the program you want to be out of debt in 3.5 years? What would you have to do? He says, I'd have to put that $2,000 a month back into the program so the program can direct me as to how much money and when to put it towards principal so I could be out of debt in 3.5 years and only pay $16,000 in interest. Okay. Well, let's do the math. So you want to be out of debt in 3.5 years. You put the $2,000 a month back in. So that's $2,000 a month. That's 36 months for 3 years. And another half year, that's another 6 months. That's 42 months. 42 times $2,000 is how much money? He said, it's $84,000. So then I pointed out, so what you're telling me is you want to take your $84,000, use it to pay down debt so that you can save yourself an additional $4,000 in interest. You want to go from $20,000 in interest to $16,000 in interest, but it's going to cost you 84,000 of your hard-earned dollars to accomplish that goal. He said, oh, since you put it that way, no, it doesn't make sense for that. He says, well, then what can I do that makes sense? I says, well, you don't have to wait to build your dream home. You could build it now, because if you wait 3.5 years, things just get more expensive. He says, well, I've been putting so much money towards the debt reduction. I don't think I have enough money saved up for a down payment on my home. Okay. So listen, I said at the time, okay, this was before I knew Jerome Pemberton, by the way. We just did a show Friday on you don't need a down payment. He showed you how to buy a house with no down payment, by the way. So listen, watch Friday's show. You're going to love it. All right. So, I said, you have the money. He says, how? I said, you have a ton of equity in your home right now. Get a line of credit, a home equity line of credit on your current home. There's your down payment for your new $700,000 home that you want to build. He says, wow, didn't know that. So that's exactly what he did. He got a HELOC, all right, a home equity line of credit, HELOC, and started that process of building his new home right away, not 3 years from now. Okay. Right now, started it. So he did that. And that was just a few years ago. The home is now done. All right. The home is now done. But even before he moved in, because there was some construction delays, there were some things that happened, the things that kind of frustrate the whole process. Because it took so long to build a house, the house next door to him sold for $900,000. Build it for $700,000. The house next door to him sold for $900,000, increasing the value of his house already. So he's moving in with equity because he didn't wait. He didn't wait. And because of that, ladies and gentlemen, every time he sees me, he's over 6 feet tall. Every time he sees me, he picks me up. I remember in a restaurant, he picked me up and twirled me around like I was a rag doll because somebody was there, a high income earner. We were there for him to tell him, here's a better use for your money so that now that you want to prepay, you can now use that to save a ton of interest on your new home. And what did he do with the home that he still owes money on? $263,000. He put a renter in it. He put a renter in that home. And now both houses are going to be paid off in about 10 years on the P.I.L.L method program. So folks, this is what we're talking about. High income earners can pay off their debt a lot faster and a lot cheaper. So what we're going to do now is put in, let me put this on the screen. Okay. And so that you guys can see what we're talking about. We're going to pull up the P.I.L.L method demo. Okay. And see what we have here. All right. And I think you're going to, by the end of this show, when we hit all the high points, you're going to understand what we're talking about. Okay. So let's take a look while that's loading. Let's look at the next thing that we have here is effective allocation. Effective allocation. How are you allocating your funds? What do you want your funds to do so that you can buy more with less? You want to channel extra funds into strategic debt repayment and reduce interest costs significantly, enabling more of your money to work towards building wealth. Now, how does that work? Okay. How do I do that? You do what my friend over here did. You want to make sure that the money that you're putting towards debt reduction, you are calculating your interest savings. Okay. So here's the program that does all that. Okay. I'm going to move this over to here, over to this screen. Okay. Here's a program that does all that. Okay. It takes what you have, all right, and then helps you to allocate the right amounts of money that need to go to debt reduction. And with a coach, we can take a look at how much interest is remaining on the debt. Here's how much interest we're saving. Here's how much interest is remaining. And anything that you do, you can then figure out, if I do this, am I significantly going to reduce the amount of interest I have left to pay? And then we can figure out that, there's a certain point where more is too much. We want the right amount of money going to debt reduction. We want the right amount of money going to wealth creation, so that at the same time, we can look at how are we building net worth? How at the same time I'm paying off debt, at the same time, how am I accumulating wealth over the next 15, 20 years with the amount of money that I'm saving? And how can I add an extra $1.5 million to my, in this case, $1,582,593, $1.5 million to my bottom line with monies that formerly were going to interest by the time I was supposed to pay off the house in 30 years. I'm going to pay the house off early. Okay. So by the time the bank wanted me to pay it off, and I don't have this because I'm using all of my money and paying interest I don't need to pay, I don't have the resources to put in to make an extra. Now, this is already, they already have 401ks. They already have investment already set aside out of their work. But if we can take that interest money, ladies and gentlemen, and put it away, my goodness, turn it into $1.5 million. And this is at 1% return on the money. The reason why I pull this up is because this is not a doctor. Okay. It's not a doctor. Let's take a look at their income. Okay. John is, he's in real estate. Rebecca's a teacher. Listen, John is a real estate agent. Rebecca is a teacher. Right now, they're making total monthly $5,091.66 on average. Their expenses are $3,700. Their average discretionary, what's left over after all the bills are paid, are $1,300. Now, if they can do this, and take what they have, you see, they're already putting money away for retirement. They're going to do well in retirement, but guess what? They can do much better in retirement and grow their net worth. If they can save this $179,000 in interest they don't need to pay, and by the time you see it's 20 right now, it's 2024, and by the time by 2054, okay, by 2054, when they were supposed to be out of debt, look here, they can have an extra $862,000, and that's at 1% return on their money, where people in investing are averaging between 6 and 11%. 6 and 11% compound interest returns on their money. This is only 1% return on their money. So if a real estate agent and a teacher can become millionaires from the monies they're not spending, what can a doctor do? What can what can a lawyer do? What can high income earners actually do to accomplish some of these goals? Oh my goodness. Effective allocation. Here we go. Effective allocation of your funds, utilizing the opportunity cost calculator that we just showed, how, and coaching, how can we manage our funds so that we can pay a lot less interest and make more money in interest by knowing how much to allocate towards each side. And in the middle, what's in the middle? Lifestyle. I can still have a great lifestyle and get all of this done. But there are people out there that have beat it into our heads. You can't do all three. You've got to choose. You either pay off debt, you either invest, or you have a great lifestyle. You got to choose. No, you don't. I choose all three. And with the P.I.L.L method, you can have all three. You can have a great lifestyle. You can eliminate your debt, pay a lot less interest, and take that money that you didn't have to pay the bank and invest additional monies towards building up your, not only just your net worth, okay, but your legacy that you want to pass on to your children. Man, oh man, oh man. You can't beat this with a stick. All right, so let's take a look at budget management, okay? Why would somebody who's a high income earner, come on, Jerome. Okay, so Michelle Nettles, are you here? Do you have a question for us? I appreciate you being here. Okay, before I go on to the next point, can we bring Michelle up? See if she has a question? Or her devices are not connected. Okay, all right. Michelle, come on back. All right, come on back. Let's get our devices connected. Just follow the directions, Michelle, and you'll be able to speak to us today. All right, very good. All right. In the meantime, Michelle, can you still hear us? Put something in the comment section here. Coming back. There you go. How about that? I see you now. Miss Michelle, how are you doing? Am I pronouncing?
Doing well. Can you hear me?
Yes.
Good morning. How are you?
I'm doing well. Thank you very much. What do you think about this conversation today?
I love it.
Okay. Now, why do you love it? Tell us why you love it.
Because I definitely would want to be paying my house off in 7 years.
And are you a doctor?
I am not.
But that's okay, because the example that I showed, they're not a doctor.
Right.
Okay. So
I'm like, hey, you could be anything if you want to save that kind of money for, your home.
exactly. Do you have a question for us today?
I do not. I just love listening in and supporting your space, Don.
Well, listen, supporting our space. Have you gone in and subscribed to our channel? Have you
I believe
subscribed
so.
to the P.I.L.L
I
method?
think I am. Now
Okay, great.
yes, I am subscribed.
All right. So would you tell others? Would you recommend that they subscribe as well?
I do. I recommend everyone subscribe. This is very good information, especially where your pocketbook is concerned. Why pay
Okay.
more when you could pay it off sooner? So I suggest everyone subscribe to the
All right.
channel.
So we're gonna put a crawl across the screen in just a few minutes where we're telling encourage people to subscribe, to like the videos, and to comment. We're going to have that ready to go, and it'll be
Okay.
crawling so people
Awesome.
can do that. So I want to thank you. So what part of the country are you from?
I'm in California. I'm in the San Francisco Bay Area, in between Oakland and San Francisco, California.
You are sacrificing to be here with us this morning at 7 a.m.
Yeah. Anytime I see you on, I always try to chime in.
I appreciate it. I appreciate it so
Anytime.
much. So okay.
I'm gonna
So
have to go on mute because I'm at work. So
we go ahead and do your thing. But thank you for being here this morning. We
you're
appreciate you.
welcome. I
All right.
appreciate you too, and thank you for having the room.
You're welcome. You're welcome. All right, everybody. Did you hear that? Go ahead and subscribe to the Pill Method, like the videos, and comment. That helps our algorithm. That helps to get the message out today. So let's go back. Let's go back to where we were. All right. Budget management. If I'm a high income earner, why do I have to worry about budget? Okay. All right. And I see another question come in. We're going to handle that just after I make this point. Okay. It helps to track monthly spending to accurately determine available discretionary funds. It helps to do that. Our program does just that. Helps to track monthly spending to accurately determine available discretionary funds. Why is that important? It is because we don't track our spending. A budget isn't to restrict what you're doing. A budget is to track what you're doing so that you can be better able to be in a position to allocate your funds appropriately because you know how much money you're making and you know how much money you're spending. Therefore, you can know how much money you're investing. Does that make sense, everybody? Does that make sense? If you track how much you're making and how much you're spending, you know when you have spent the money that you need to live that month. Okay. You've done everything that you needed to do, including adding to your budget a lifestyle budget. How much do we want to spend on lifestyle each month so it doesn't feel like I'm working just to pay bills? Okay. So we can have a great lifestyle that's plugged in. Our other bills are plugged in. Our debts are plugged in into the opportunity cost calculator. And then what the opportunity cost calculator can help us to see is how much money we actually have left. The reason why it feels for so many of us, it feels like paycheck to paycheck is because we're not, I will repeat it one more time. We're not tracking our spending. And it's simple. If you track your spending, now you know how much money you have left over. And it doesn't feel like paycheck to paycheck. Excuse me. And then you can use your discretionary funds to attack debt and to create more wealth without feeling as if I'm sacrificing lifestyle. Our program does that for you. Let's see what Ken Russell has to say. Says, hi, Don. Hope you don't mind that I repost some of your videos on LinkedIn. You better repost them. Ken, I don't mind at all. Ken, I love the fact that you're reposting that. And listen, on all your other social media as well. Please do. And if our videos help you to help more clients, listen, all the better. All right. Jerome Pemberton was in here, and I'm almost confident that he's going to get more clients because of our collaboration. And so, Ken, I can collaborate with your clients in Canada as well because the name of our business is P.I.L.L Method International. P.I.L.L Method International. We work in several countries and including Canada. So, Ken, thank you very much for being here this morning. All right. So, what else can we do, folks? Track your monthly spending to accurately determine available discretionary funds. Strategic financial planning. Why is that important? Strategic financial planning. It provides a clear overview to better allocate funds towards debt reduction, investment, and other financial goals. You see, it's a lot more fun. Oh my goodness. It's a lot more fun when you have options. A lot more fun when you have options. Okay. Listen, I grew up poor. In fact, I didn't know how poor I was. Okay. My mother, single mom, 4 children. All right. She's not a professional. All right. But she did work and she took care of 4 kids and didn't make us feel like we were poor, even though now I'm looking back. Yeah. We were pretty poor. Okay. But here's the thing. We paid on, paying on the bills. All right. We paid on I never during the time that I was growing up paid a whole bill in full, like the gas bill or the electricity or the water bill. We paid on those. We didn't pay them off. We didn't pay them all at the end of the month. So whatever your bill was, whatever it was, we put something on the bill. We didn't pay the entire bill. I didn't know what that was. Okay. And so now that grown up, I have options. So when we need a refrigerator, we just go out and buy one. When I need a set of tires, I just go out and buy a set of tires. Did you know the whole time I was growing up, for most of my life, we never had a car? We didn't get a car for the family until I was like a junior or senior in high school. And not once do I remember ever filling the car up. So go and fill it up with gas. Not once. Okay. Gas was cheaper. So you can go and put in $2 or $3 worth of gas and you can drive for a while. But now we have options now. We have options. In fact, some of us make so much money, we don't even need gas anymore because we're buying electric vehicles. We have options. It is so good to look at this, to take a look at this thing. Strategic financial planning provides a clear overview to better allocate funds towards debt reduction, investments, and other financial goals. High income earners have options, and you can increase your options once you know there are variables out there that no one else is talking about except the P.I.L.L method. You have variables that are out there. You don't have to choose between these things. You can do things simultaneously and do well and enjoy life along the way. There are some others out there that would make you think that you can't enjoy life along the way while you're paying off debt and making debt a bad word. Debt is not a bad word. Debt is a good word. The paying cash for stuff actually limits your ability to invest. Okay? Paying cash for stuff severely limits what you can do. All right? Let me bring something else up over here so that I can show you what I'm talking about. All right? Let me pull this up over here and then I'm going to I just lost it. Hold on. There it is. All right. I'm going to pull some other documents up now that I'm thinking about it. All right. We want to pull up this document. All right. And let's see this document. We'll pull that one up. Okay. Let me see here. That one. This one. This one. What else can we do? Here's a commercial example. All right. And here's some more. We're going to bring these up. Okay. So we're going to open these up as well, along with our example. Okay. There we go. All right. So let's bring this back over. All right. Let me pull this up. Okay. So here we have a situation where we have $1 million worth of debt. $1 million worth of debt. We've got student loans, we got credit cards, we've got a mortgage, we've got over $1 million worth of debt. Let me bring this up a little bigger here. All right. And let me show you what I mean. If I have $1 million worth of debt and the bank wants me to pay $692,000 in interest on that debt. Okay. But I end up paying $179,954 instead. Okay. That is a $512,000 interest reduction. $500,000. The bank wanted, listen, this is a high income earner. This is a high income earner. Okay. Okay. 12,000 monthly base income, 12,000 a month, not including bonuses. Not including the bonuses. This is just the base. All right. Including bonuses. We're not even talking about the bonuses, but with the money that they have now, they qualified for all of these loans. They're making their payments. They're not struggling at all. No struggles here. But because they're not struggling, is that an excuse to give the bank $692,286 in interest just because they're not struggling to do it? There's no reason at all. We should always be looking how we can be better stewards of our money. So instead of paying $692,000, they can pay $179,954 or less. Now, what would the interest rate have to be to pay $179,000 in interest instead of $692,000 in interest, high income earner? Your interest rate would have to be 1.1%. 1.1%. This is the effective interest rate. Here is how you need to think about this right now. And I'm looking straight into the camera at you, high income earner. Do yourself a favor. Share this information. If you're a doctor, if you're a lawyer, if you're a high income earner, whatever it is you're doing, if you're if you're a top earning real estate agent, all right, if you're a broker, no matter what it is that you do, if you're a high income earner, pass this information along to people in your industry. I believe you'll be blessed because you do that. Give them this information and let them know that if you can borrow money at 1.1%, what are you doing paying cash for anything? Because you can invest your money at a national average of between 6 and 11%. If I can invest my money at a national average of 6 to 11%, what am I doing paying cash for cars? What am I doing paying a cash for a house? What am I doing paying cash for anything, even though I can afford it? I told one doctor friend, okay, that their daughter was getting ready to go to college. All right. Their daughter's getting ready to go to college. And he was getting ready, while I was there, he was writing out a check for her tuition for the year. I said, and he talked to me about it because he's also a client. Okay, because we need to put that into his program. He says, well, I'm getting ready. Let's add this to the, my expenses. I'm getting ready to write a check for my daughter's college. I said, really? I says, well, haven't you heard of student loans? He says, well, why would I use student loans when I can afford it? Why would I use student loans when I can afford to pay for the college? Why would I do that? Okay. Now, here's the thing. This was a doctor, daughter going to Oakwood University here in Huntsville, Alabama, stroking a check. All right. So I said, well, if you got student loans for your daughter, when would you have to start paying the student loan back? So when she graduates, says, when would you have to start paying interest on the student loans? When she graduates. Well, that's 4 years from now. I said, yeah. I said, why don't you take that money, put it in one of the many investments that you already have, that's safe, and make interest on that money, and then get student loans to pay for the whole college thing. Says, well, why would I do that? Says, this is why. Because now you get to use their money for the next 4 years for free, while you take your money and put it in an investment, and it's growing for 4 years. And then when she graduates, then you can take the money out of the investment, pay off the student loans, pay no interest for using their money for 4 years, but you get to keep all the money that the interest money that money earned for you. How about that? You see, with the P.I.L.L method, we're able to help you to allocate funds in a way, give you other variables that you hadn't thought about, so that you can increase your bottom line. Okay? So you can increase your bottom line. So Jerome, what are you doing in here, man? Listen, did I say something Jerome, did I say something that caused you to have to come on in here and talk to us this morning? Let's bring him on. Let's bring him on stage. Because we can't hear you yet, Jerome. We got to bring you up. There you go. All right. Yes, let's do a 2-shot. Let's get the graphic off. Okay. Hey, Jerome, what's up?
Hey, all is well, all is well. You're talking my language. I don't know if you know, I have a son in med school right now.
I did not know that.
So we talk about, right now, he's first year. We're talking about how much debt he's going to accumulate and what strategies we're going to use to get rid of the debt. Of course, we have your formula, but we also talk about how much income he's going to make also.
There you go.
That's one of the things we're always talking about. So I said, don't worry about the debt. We have a plan for that. But it's not just for my son, it's for a lot of clients that we have. So he's over the division for the company of zerodown.health. So that's for health professionals when they're, purchasing homes. Of course, they have all this debt. They're debt heavy, and it stresses them out.
Yes.
While they're in the med field. But a lot of people don't talk about that type of stuff. The stuff you're talking about today, or high income earners, period. The debt in, running a business, if they own a business, the amount of debt you have is a yoke over our heads.
Yes.
Our heads, my business has a lot of debt, right? And we talk about that. But it's serious. And it does affect your health.
But you see, because we don't know that these strategies are available to us, we don't know what we don't know about debt. We assume everything we need to know is already known, and with what's known causes the stress.
It does.
But what if we knew how we could pay a lot less interest with the money that we already have, and it doesn't have to affect our lifestyle? What if there's a way to do all of that? Do you think that would be more palatable?
That's more palatable, but that also freed me, because I was taught to focus, pay the debt off, pay the debt off, pay the debt off, right? And we're not going to get into that conversation. And that part right there stressed me out. That part right there stressed me out. And knowing that would I have to live life and be in debt for the rest of my life, that was in the back of my head, and a lot of other people had that I'm having conversations with.
Jerome, can I show you this one thing here? Well, I want to bring this one thing back up on the screen. We're going to put this example back on the screen. Here we are. Okay. So instead of 36 years that this high income earner was going to be in debt, 36 years, they can now be out of debt in 9 years and enjoy the journey along the way, put themselves in a position so that they can take the money that they're no longer paying the bank and add to what they're already doing for their retirement, add to that an extra $4,211,000. $4,211,000. And this is at a 1% return on their money. And they can do all of this and not sacrifice lifestyle. What do you think, Jerome? Let's bring Jerome back. So I didn't know your son was in you said med school?
He's in med school. He's in Temple, Texas. He's at P.I.L.L medical school. He's going to be watching these episodes, but they talk about that in school. They talk about the debt load,
Right.
Get them in med school. They're basically saying, some of the guys are saying is like, you're going to be making so much money. Borrow the money is basically what they're telling us, to borrow the money, increase your income. And because you make so much money, you're able to pay those loans back, which I don't quite see that too much in my field. I see a lot of high net worth people that have 400, 500,000 in loans, and they still haven't paid them back. It's what I see.
Listen, I see that all the time. And listen, Jerome, why don't you tell the people what you do and how do you see that? Okay, because they kind of get what I do, but tell them what you do.
So over the past 25 years, I help people purchase homes so they don't have to use their money to put it into a liability. So we use creative strategies. We find the banks. So let's say if a client, like that illustration you were saying before, that he wanted to purchase a house for $700,000. Well, my clients don't have to put a down payment. We find them a bank. And I'm a realtor, guys. I'm not a loan officer. Prior to this, I've done loans for over 10 years. So I figured out a formula that all mortgage products.
All right. We lost you for a second there, Jerome. You're muted. You're muted. Jerome, you're muted. And we lost you at all mortgage products. Nope, can't hear you yet. Nope, you might have to go out and come back in. Okay, so listen, while he's doing that, ladies and gentlemen, he's exactly right. The people are focusing on these things. They're not taught in school how to deal with it. I see high income earners all the time with a mortgage and student loans, and they've been out of school for years, but those student loans just hang on. And for some people, those student loans delay when they can start having a family because they have no idea how to do it all, because we're not taught how to do it all. We're taught just make more money and then just throw money at your debt. Make more money and throw money at it. That's what we're taught to do, instead of how to be strategic with our money, pay it down in such a way that we can pay the debt down by saving interest. Here, in this case, $500,000 in interest. That is a 74% reduction. Let's put that back on the screen. A 74% reduction in interest savings. Okay, let's wait for it to get back on the screen so you guys can see this. There it is. Okay, 74% reduction in interest, saving $512,000 interest. So now we can pay that debt off in 9 years, but we're tracking all of this so that we can turn it into another $4 million on top of what we're already doing. All right. It is so important for us to keep these things in mind. Borrow money cheaper. Okay. Everything we want to do, we want to make sure that every dollar that you have, high income earner, we want to make sure every dollar that you have is making babies and working as hard as it possibly can. We want your money working harder than you're working. Okay. We want your money working for you harder than what you're working. And what we're taught is to take our money and make it work hard for the banks. That's what we're taught. but it's taught in a way, it sounds like it's a good thing for us. Everything that we've been taught to do, best practices, not really the best for us, but that's all that's out there. And the reason why we're in the situation we're in is not because we're irresponsible with the money. It is because we're following the advice of the experts. They don't understand how banks make their money. Therefore, we fall into the trap of being a natural resource for banks. How they can mine, M-I-N-E, how they can mine our blood, sweat, and tears and turn all your hard work into money for them. Jerome is back. All right, Jerome, let's bring Jerome back. Jerome, I'm glad you're here today.
I'm always happy to hear the information that you're sharing with everyone. It's so important.
Yeah.
Like it's vital.
Go ahead. Go ahead and tell us what you were telling us. Listen, we can take the graphic down.
What I was telling everyone is that for years, people have been told the right way is to put a down payment down. That's what we were told. And years ago, being in the mortgage industry and the banking industry, I saw so many different products out there where you did not have to put a down payment down. So as a consumer, what do? We listen to what we hear on the news. We listen to loan officers. We listen to realtors. We listen to financial planners, which I think people mean well, but they're only recycling the information that they were told.
Did you hear that, folks? Because it's recycled information doesn't make it correct information. Is that right, Jerome?
Yes. And so there was a lot of things I was told that just didn't make sense. So I said, if an investor is looking for money to buy a house or to build an apartment or to build a hotel or buy a hotel, they're using other people's money. So why aren't we doing these things when we're purchasing a home? They're buying an asset. We're buying a liability, right? And so looking at it, I was like, there's banks out here that would give you all of the money and you don't have, they're not asking me for a down payment. Why isn't everybody doing these things? Is what I said myself at an early age of my 20s, right? So this is not new. It's not new information. It's been out here, but people listen to a lot of people that did not understand money or financing.
Exactly. So what you're saying is that you've been doing what you've been doing for 25 years. It's been there all the time, but still most of us, has anybody ever told you or asked you this question? If what you're doing is so real, so true, so good, how come everybody doesn't know it? How come everybody's not doing it? Have you ever heard that?
Heard it.
What's your response to how come everybody's not doing it?
I don't know why everybody's doing it. But it's interesting that there's clients that come to me, they've already bought 3 or 4 houses. And they said, I've been on this earth this whole time. I bought a bunch of houses. I've never heard this information before. So like in your book, Don, there's a chapter in your book that says, and it's true, when I started listening to what you were saying, I had to put the book down, Don, and rethink what you were saying in the book. And it was a book that I had to really think about. It's not about the rate. It's about how much interest I paid all these years and didn't understand how the banks were making their money, right?
Yes.
And I just didn't understand. But it's right in front of us, but we don't know how to read an amortization table.
Yeah, let's put the book on the screen while we're talking. So listen, so here's what we're talking about, ladies and gentlemen. This book that he's mentioning is out of 33 million titles on Amazon. Out of 33 million titles on Amazon, and there's a lot of titles on finances. This is the only one that teaches you how to read an amortization schedule and how to take advantage of it so it doesn't take advantage of you. That's how little information is out there on how an amortization schedule actually works, how much interest they're actually charging you. And now you can take a look at your loans, not from the standpoint of interest rate, but controlling interest cost. Bring down the cost of borrowing money at a discount. So here's two things we're talking about for high income earners to save more money. One, you don't have to put a down payment on your house. You can move into your house with no down payment. What? Yes. And then take that same house and your student loans and your credit cards and what you have and pay it all off in 7 to 9 years while you are enjoying the fruits of your labor, and put more money towards retirement and building up your legacy to pass on to your family. You can have it all. And this is a situation with the P.I.L.L method. You can have your cake and eat it too. I'm surprised I don't have more questions in here. I'm surprised I don't have more people coming in here. Maybe let's give them the link one more time. It's pinned at the top there, but let's give them the link one more time. Maybe you want to come in and ask some questions of Jerome, ask some questions of me, or at least put it in the comment section. A question or comment. Just let us know what you are thinking about, ladies and gentlemen. We have some people in here, but do this for me. We need your help. We need your help. Okay. Pass this information on to people. You want to subscribe to our channel. Listen, I'm taking a look at the analytics, and my producers are taking a look at the analytics. Do you know that we have several people who watch and rewatch these videos? Okay. And the number of people who are already subscribers, do you know that there are people sometimes outnumber our subscribers that watch these videos, but they're not subscribing? Go ahead and subscribe, and click that little bell, and every time we put a new video out there, you'll get a notification. And each one of our videos is actually a mini master class. We give out so much free information here. Jerome, come on, man. So you're talking about the book, what you got out of the book. Finish the rest of your story.
So the book breaks it down to make you think differently. It made me think differently. And then what I'm finding out, Don, when you're dealing with high net worth earners, sometimes they think because they know everything. And then when we're having conversations with them, sometimes I have to throw other concepts out there for them. I was like, okay, you this is how you acquired all of this debt, right? But then you're talking about the stress of the debt. What about if you found a house, right? A house that you want. You don't have any debt on this house. You don't have no debt on the cars. Let's talk about what would life look like with no debt. Let's have that conversation. And they said, I've never had a conversation like that before because I always thought that I would be in debt until I leave this earth. And a lot of people think that way.
Wow.
They don't believe that is even possible, right? My wife believed it. I didn't believe it because I'm just being honest. I didn't believe it because I'm borrowing this money to keep the business operating, right? My wife is, a high net worth earner, right, in her field. And she's like, no, we can save the money. So these are conflicting ideas, right? And even though I sit right next to her, but in my mind, they're conflicting ideas until she said, hey, I need you to start listening to Don's episodes again. And I started listening to them again to believe that it could be true for me, that I could be out of debt. And then I started thinking about Don, about what would life be like if we had no debt, to the point I was saying, what happened, Don, if I just sell the business because I don't have no more debt and I take that stress off of me? So my son was like, no, Dad, don't sell the business, right? He was like, I'll get involved in the business while I'm in med school. But he didn't understand where that was coming from. That was coming from a debt standpoint. If that makes sense. It was just strictly debt. It had nothing to do with the income I was making, had nothing to do with anything else. It was like, can I be free from this debt and just live a life without debt?
Wow, that is something to think about, because I run into the same thing, that people they're thinking, because the way that we hear it over and over again, we think that's all there is. Okay. What I what I see is all there is. What I see is all there is. And folks, when it comes to finances, there's more to it than what we can see, what we've heard, and what we've been taught. This is why we have our channel here, and you want to subscribe to it. So make sure you subscribe and share this information. And already, Jerome, you're sending you sent a client to us already for us to talk to.
Right. So Demonet, she's already on the bandwagon of their strategy. Her husband pays the bills. Demonet's money just goes strictly to debt. That's their strategy. So she just bought a house, $200 out of pocket, right? So her mindset now is, hey, I can pay this debt off in a shorter period of time that I think I can. And she has student loans. I think she has about, she's a teacher. I think she has about $60,000 in student loans. I think it's around 60,000.
Right.
And she doesn't make 60,000, right?
Mm-hmm. Mm-hmm.
So the strategy to keep you, because she's making less money, right? And I said, Monet, you need to just talk to, Don's organization. And I said, maybe you need to, her strategy was, if I stay in teaching for 3 more years, there's something else that I don't want to do. I really don't want to do it just to pay the $60,000 of debt off. And it's stressing her out.
Right.
So I deal with other teachers. They're stressed out. They make very little money. They're stressed out. They have these student loans debt. They just don't make enough money to do the things that they want to do.
Wow. Well, listen, can you hang out for just a couple more minutes? I want to make sure I hit all the points before we get out of here today, but hang out here. We're going to bring up our example on the screen again and take a look at alternative saving strategies. Alternative savings strategies. Rethink your savings, ladies and gentlemen. Rethink your savings instead of traditional bank savings accounts. All right. Our discretionary money generally sits in savings accounts. We have our other investments that we're putting our money in every single week or 2 weeks or every month. We're putting money in there because it's taken out of our paychecks as a deduction. But there's other things we could do with the money. Do you know how many people I run into that have thousands of dollars in a savings account? Tens of thousands. And I've seen even over $100,000 in a savings account because it makes us feel better when it comes to long-term financial strategies, because somebody said you need to have cash put back. You need cash put back so that if something happens, you have 6 to 8 months, maybe a year worth of cash so that you can continue to pay the bills if something should happen. Well, let me show you something here. Rethinking savings. Instead of traditional bank savings accounts, consider permanent cash value life insurance for its multi-purpose and functionality and living benefits that it has. Okay. So cash value life insurance makes money for you. You still have access to your cash. And now, instead of making 0.1%, here's a strategy that you have all your cash available to you, but you're making somewhere between 6 and 15% on your money. And you have it to borrow out of the life insurance policy anytime you need the cash. So listen, there are multiple ways you can have liquid money that's making a lot of money and still provides for you a ton of other benefits. A ton of other benefits. Here's another one. Leveraging insurance. Explore how life insurance can serve as a financial tool, offering accessible cash reserves to grow over time, tax deferred. Do you see now? We can take our money out of you can jumpstart a insurance policy. You can jumpstart it. Take that $100,000 out of your savings account, put it into a permanent life insurance policy, draw out 90% of that money right away, okay, tax free, and you can invest that money in something that's tax deferred. You could use the same money twice. It's amazing what you could do once you put that money in insurance. It is crazy. And then that's an extra added benefit when it comes to retirement, because that money that comes out of the insurance policy that you're adding to your retirement income is tax free, because money you borrow, you don't pay taxes on. And the way that the insurance policy is set up, you are borrowing the money. They're not paying you the money. Oh my goodness. Let's talk about that one. So there's a lot of things that we could do, ladies and gentlemen, when it comes to this. I wanted to make sure we get all of these points in. And now we can talk about real estate investment opportunities. Real estate ventures. Discuss the benefits of real estate investments as a stable and potentially lucrative asset class. Now we're talking about the ability to turn your active income into passive income. I'm talking about monies you don't have to even work for. And even though you're a doctor, even though you're a lawyer, even though you're a high income earner and you love what you do, how would it be if you could have to be able to be in a situation where your work optional, you work because you love to, not because you have to. You have something else to put in, add to this conversation, Jerome?
No, I think that's one of the things that we talk to doctors, high net worth income earners. You make enough money to pay your bills, right?
Mm-hmm.
After that, you have all this discretionary income once you figure that out, right? And so now there's a different conversation where what things can I do to deploy my money so my money is making more money and I'm not involved, right? Where it's collectively bringing money into me, and I can have somebody else. That's another class of having somebody else manage that for me. I'm just the investor, putting it into different opportunities, but I'm having somebody else manage that.
Oh, so you don't have to actually, there's several different ways we can get into real estate. I could own the property outright, or I can work with somebody who owns property, right? I can
Right.
work with somebody who is managing the property. I invest in their venture,
Right.
and then they pay me a dividend and interest on my money. Well, that's a different way of doing it. Yes.
Exactly. So,
okay.
That's one way, right? Because some people think, oh my God, I got another task. I got to do all of this work. I was like, no. Some people we talk to is like, no, just take this $50,000,
Mm-hmm.
put it, let them do the work. This is how much return you're going to get off this $50,000 or $25,000, or leveraging. We're talking about leveraging, right? Go borrow the money from the bank. Go get this 50,000, 60,000, 100,000 from the bank, and then put it into this project, right?
Mm-hmm.
And then you're just responsible at that time as paying that monthly note, right?
Mm-hmm.
And then eventually, when that project is producing income, right, it's going to pay that note off. So there's so many different strategies when you can get into these games. And doctors, because of the income they make, you'll be surprised how many other things and practices that they're in, right? And they're making money on top of their money they're getting from in the health field.
Wow.
So that's why all of this episode is so important. So they can listen to this episode, right? And it can pass down, especially with our clients, right? That we're working in the healthcare industry. I could take the two videos, this video here.
Yep.
Because that's the stress. The stress is I got all this debt, right?
Mm-hmm.
I'm making this type of money before I buy these houses, right? I could send them to Don, and I know, you know what? I know this house is going to be paid off by the time I'm going to buy my next house, which is going to be 5 to 7 years, because that's when the next time they're going to come back to us. And guess what? We're going to do it again. So let's say their first house they buy at 600,000. Now the next house they may buy at $1 million. Well, they're not going to have to put a down payment down. They're going to use the P.I.L.L method the first time and the second time. And then they can decide what they're going to do with their money, right? Because they're going to have all of this discretionary money just sitting somewhere. Now they got to get with somebody to say, what we're going to do with this.
Exactly. So listen, we have a video from a high income earner. The number one motivational speaker on the planet right now is Dr. Eric Thomas, E.T. the hip hop preacher. We're going to bring him on, take a quick break, and then we're going to come back. And then in the meantime, Jerome, go ahead and put it in the private chat how people can get a hold of you, and we'll put it up on the screen. Let's hear from Dr. Eric Thomas.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, ladies and gentlemen, listen. What Dr. Eric Thomas did, he requested a savings and earnings report. And some people might be thinking, well, of course he could pay off his mortgage. He's the number one motivational speaker on the planet. He can make $150,000 an hour just from one speech. Okay, he can do that. And so what we can also understand is that what we did was not tell him how to throw money at the debt. What we did was how to strategically pay back the banks in a way that you pay the least amount of money at a particular time to maximize your interest savings. So it is a strategy that optimizes the use of your money, making every dollar work as hard as it possibly can. So you want to go to ice10k.com, ice10k.com. We're going to put that on the screen for you. All right. Let me put that in ice10k.com. We're going to pull that over and it looks like this. Okay. Scroll down underneath Dr. Eric Thomas' picture here. That's a video. Scroll down and say, get your savings and earnings report. Click on this. Click on get your savings and earnings report. Click on that. Fill this out. Get it done today. Find out the month, day, and year you can be debt free. And not only that, but how much interest you could save and potentially how much those savings can earn for you and your family. And I want to add one thing to what Jerome said. If you're a real estate investor, you're probably not interested in paying off the debt at all. What you're most interested in is how quickly can I grow equity in the property and then make sure I'm paying the least amount of interest to get that equity. Oh, that's a different play. That is awesome. If you can get your equity 10 to 15 years sooner, cash out that equity, whether it's with do a cash out refi or with a HELOC, get that money out of that property, put more debt on the property, and then invest that money as well. Oh my goodness. When you can do that and then calculate how much interest you didn't have to pay, now you can also calculate the long-term benefits of taking the money that you didn't spend on interest and now calculate the returns, the compounded interest returns on the money you used to pay to interest that you're no longer paying to interest along with everything else. This is a game changer. All right. So get your savings and earnings report, everybody. And don't hesitate. Get it done. It's free. And then you can learn how to better utilize your money. go ahead and subscribe to this channel and make sure you're sharing it with other people. Subscribe, like, and share. All right. So let's get back to where we were. All right. And let me make another point before we bring our guests back here. We talk about equity markets. Here's another place you can invest. Okay. Highlight advantages of investing in major indices such as Dow Jones Industrial Average, the S&P 500, the NASDAQ, and the like. Okay. Over the years, all right, there's less risk if you invest here. And over the years, that they grow about 10% a year on average. Okay. Great place to put your money. All right. So talk to your investment strategist and see how you can use these safer ways to invest your money. Okay. Debt repayment strategy. Avoid common pitfalls. Explain the risk of paying off the wrong debt first, or allocating too much money towards a debt reduction at the expense of investment opportunities. We talked about that a little bit earlier, but we didn't talk about paying off the wrong debt first. Okay. Sometimes we pay off the wrong debt because it's easy, meaning I don't owe very much on this. Therefore, I'm going to pay this one off, like the credit card I'm going to pay off, or I'm going to pay off my automobile. Folks, we pay stuff off, not just to say we paid it off. We pay it off to save interest. So if I'm taking money out of my investment, out of my bank or whatever, to pay off my car, that's costing me $80 a month interest. Why am I doing that when I'm ignoring the fact that I'm ignoring my mortgage that's costing me $1,000 or $900 a month interest? We pay it off this because it's easy. But when we take a look at the amount of interest that we're saving when we pay it off, it's pennies compared to if we take that same amount to put on a different debt that's costing us more money in interest. Forget about the debt snowball. Forget about the avalanche methods and start thinking about interest cancellation technology and education. The P.I.L.L method opportunity cost calculator will do all of this math for you and keep you from making that big mistake. All right. So investment versus debt. Look at this. Compare scenarios where borrowing at a low interest could lead to higher returns if the borrower funds are invested wisely. I want to borrow money at a low cost so I can take my cash and invest it at a higher return. That's all we're talking about here. Okay. Borrowing money at a low cost so that you can take your money and put it towards an investment that makes high returns. All right, Jerome, come on back into this conversation, man.
So one of the girls that listened to the show, one of the ladies, I shouldn't call her girl, ladies listened to the show. Was that Friday?
Friday. Yes, Friday.
And she called me yesterday and she said there was something that stood out, what you said about interest rate that doesn't matter, freed her because she's like, I don't have to take my money. It was offered because she's a single woman.
Yep.
And she's going to buy a fourplex. It's going to be her first investment property. So she has funds, right? And so I was telling her that she doesn't have to put a down payment down on the fourplex. But what freed her from that show was I saw a different plan where I can buy this fourplex, live in that one of the units as a primary residence for a period of time. But that's going to be my first investment property. I know I'm only going to be in that fourplex unit for 3 to 4 years, right? And then I know I can go buy another property. But I don't have to put a down payment down. That freed her because she was taught a concept like I was taught. Lower interest rate is better, have a lower payment. But she didn't see your other episode that you talked about when you took that investment property.
Yeah.
And that investor went and borrowed from a hard money lender. Yeah. I'm going to tell her to go listen to that episode to see how he was still producing income with a high interest rate of, I think it was 18% was the illustration, if I remember correctly.
Okay. Well, listen, here's what we're looking at for so people can understand that. Remember, I'm bringing back our, our situation here where we have our program here for paying off the debt. Over here in the red, this is how the bank wants you to pay off your debt. Okay, starting out at over $1 million, and look how long it's going to take them to pay off this debt. 30, all right, 36 years. 36 years to get to zero debt. Here's what we're talking about. Starting out at over $1 million and then paying it down like this. Okay. 5 years in, they have $700,000 still left to go. With the P.I.L.L method, they only have $523,000. Okay. The next year, $689,000 left in debt. With the P.I.L.L method, they're at $392. At any point here, they don't have to pay it off. They got plenty of equity now within 5 or 6 years. So if she was planning on that property, now thinking of it as a 30-year investment, what about if we could pay it off in 8 or 9 years? Conceivably, we can get to the point where it's half paid off a lot sooner, which means there's more equity, which means there's a lot less interest that she paid. And then she can put some additional debt on it, take that cash out, and buy other doors with that same money.
Yes.
This is a powerful concept for investors. All right. So investors don't have to pay the properties off. They just need to get my equity out, and I need to pay a lot less money for it. I can go up to talk to 100 real estate agents. Okay. 100 real estate agents in a room. And I say, I bought a property for $500,000. And 5 years later, I sold it for $700,000. And I asked the question, how much money did I make? Bought it for 5, sold it for 7. And when I asked the question, how much money did I make? What are they going to tell me, Jerome?
They're just going to tell you the difference between the two.
And what is the difference between the two? 500 and 700,000.
They're going to say 200,000 minus their fees.
Right. And so guess what they didn't calculate? How much interest they paid to get it. And they paid way too much interest. Therefore, if they subtract the interest that they paid, they don't have the profit that they thought they had. If that interest is over $100,000, which it would be, that interest is over $100,000, then their true benefit is less than $100,000. It's not $200,000.
Right.
And that's where we're trying to help people to see is if I can take that money, high income investors, high income earners, and put money away so that I can do more. I can do this. Invest versus debt. Your banks are the biggest borrowers in town. They've learned how to leverage other people's money to make money and learn how to pay pennies on the dollar for the use of that money. High income earners, you can do the same. Please go ahead and fill out that information today. Contact us. If you don't feel like filling out that information, so we're going to put Jerome put his number in there. I'm going to put our business number in, and I'm going to even take calls today. All right. So what we're going to do here is, all right, let's put it in here. Okay. 256-886-18. Okay, 1867. That's our office number, ladies and gentlemen. We're going to put that on the screen for you as well. 256-886-1867. And we have operators on duty right now that will take your call. Just tell them, leave a message. Have Don call me today. Because some people don't want to put their questions out here. Some people don't want to come on stage. Some people don't want to do that. Call now. The operators will take your calls, take a message, and then you can just tell them, hey, have Don call me. Generally, Jerome, it costs at least, even with our discounted consultation fee. Our discounted consultation fee is $150. Somebody calls today, they don't have to pay the consultation fee to ask a question. How about that? You have no reason now not to do this. And you gave us your number as well. We put it in there. And what can people expect if they call you now looking for, I'm getting ready to buy a house. I want to take advantage of no down payment. I want you to understand this, what we're actually saying. FHA, 3.5% down. Conventional, at least 10% down. And then some people are even suggesting you put 20% down. What Jerome is talking about is no percent down, no down payment. What can they expect if they call you today, Jerome?
They're going to get clarity on concepts that using the P.I.L.L method, and then what we're talking about is that distracted, and they're going to have to go back and listen to some of the other shows of, instead of putting the money down, the biggest strategy is about how much interest you can save by using the strategies that we're telling people to use, about using the bank's money. But if they go back to the show from Friday and see how many months, like in one of the illustrations you showed on a house for I think it was $400 and some $1,000, where they started day one at month 84 because the money they were going to put down on the house, how much interest you save that family. So the strategies marriage each other, where you're going to pay a lot less interest and not focusing on the interest rate that they train us to look at. But you're going to have more options of looking at what banks are out there that's going to give you a strategy so you don't have to use your money, then use Don's strategy to purchase a home and save a lot of money. I think
wow.
It is something $1,000 in that illustration, and that one strategy that using the P.I.L.L method that our client will save because we did it the opposite way, not the way the bank is telling us to buy, doing it the P.I.L.L method way. That's what's powerful. And I don't expect everybody to understand that, Don, based on what I'm saying right now. They just need to call you, Don, or they need to call me, and they'll get a better understanding about this, how much interest we're talking about saving a family, which is life-changing.
Well, let's bring over, since you brought it up, let me put that on the screen here. Here's an $820,000 mortgage, $820,000 mortgage at 5%. High income earner says, my payment is $5,455.48. We can easily afford that. But look and see what happens with the amount of interest the bank wants on this loan. Okay. $820,000. The bank wants a total of $1,143,972 in interest on this loan. That's a total of $1.9 million, $1,963,000 for that house. Your $820,000 house, the bank wants you to pay $1,963,000 for it when you add into it the amount of interest. So let's take a look at how much interest we're talking about. On this loan, when you start paying it back, you're paying it back at $600 and $700 a month because the rest of the money goes to interest. Look at that. Look at that. Look at that. You can save a ton of interest by watching our other videos. You know that by prepaying money, you can save a ton. So high income earners, let me show you this. But while we're getting ready to get out of here, okay, we're getting ready to get out of here today. But if I prepay, this is my cumulative principal and cumulative interest. This is how much principal I would pay down in 1 year. That's all my principal payments added up, $8,329.65. If I prepay that on line one instead of over 12 months, do you realize it saves me over $50,000 in interest I never have to pay? It is amazing.
Don,
go right ahead,
I have
sir.
a real client right now, a friend of mine, that I said I wouldn't represent him.
Yeah.
Because I said I would do a disjustice if I allow you to do it this way. He's got to put 20% down right now. Can you please show everybody that this guy is going to put 20, my friend is going to put 20% down, and he doesn't understand what you're talking about right now. And I said I wouldn't be right as a friend knowing that you did it the opposite way without me showing you this way. So whatever 20% is.
Let's do that. I got 820,000. Okay.
800,000 right now.
20,000. Okay. Boom, boom, boom. That's 820,000. So if he puts 20% down, so we're going to multiply that, okay, by 20%, okay, equals $164,000 he would put down. Okay. So he put $164,000 down minus 820. Okay, so his loan would be 656,000. 656,000. Okay, $164,000 down. So he could do that. And then he would end up with a $656,000 loan, and he'd start out at payment number one. What Jerome is talking about is if he could take that $164,000, okay, keep it in the bank, get the $820,000 loan, and then put down $164,000 as a prepayment. Okay, look at what it does. Watch cumulative principal, and we're going to go down $164,000 on this loan. 164,000. Look at this. Look at this. Look at this. Look at this. 164,000. Listen, 120 payments. Okay, we've already knocked off 10 years off this loan by putting it down as a prepayment. Okay, 164,000. We're going to keep going. 164,000 right around in here between 152 and 153. Okay, 153 payments knocked off immediately. Okay, so if we take 152 payments, divide that by 12, that tells us we've just knocked off over 12 and a half years off this loan. Okay, and saved almost $670,000 in interest, and we still have our $656,000 loan. But we start here instead of at payment number one if we use that same money as a down payment instead of a prepayment. If you can afford the mortgage payment, don't ever put a large down payment on the loan. Don't do it. So, Jerome, is that what you were talking about? Is that what you wanted the people to see?
That's what I want everybody to see. Right there. That one strategy right there.
Well, ladies and gentlemen, we're getting ready to get out of here. I want to thank everybody for showing up today. Listen, share this video with as many people as you can, whether they're high income earners or average income earners or even low income earners. They can all benefit from P.I.L.L method strategies and our opportunity cost calculator that optimizes the use of your finances. Not only that, but let's give Jerome a call as well and let him talk to you about how you can not only get your house, all right, with no money down. Let's talk about, give us just one example of no money down, but also very little money out of pocket. What does that mean, Jerome?
That's awesome. So give us a call so you get understanding of what people are doing.
All right, ladies and gentlemen. So what we're saying here, folks, is that he does for these clients. He has strategy. Not only that they can have no down payment. They've got strategies where they're not even paying closing costs. That he's got strategies where they're getting most, if not all, of their what is that called? That money they put down to.
Oh, that closing costs paid strategies.
Yes, closing cost paid strategy, and what that earnest money.
Some of them are getting their earnest money back because it's planned out ahead of time.
They're getting their earnest money back. And the young lady that I talked to on Friday moved into her house, 4-bedroom house. Only money out of pocket was $185. That was amazing to me. That's less money. It was going to cost her over $2,000 just to move into an apartment. She moved into her own 4-bedroom house. Out of pocket, $185. Ladies and gentlemen, there's so many strategies out there that can save us money and make us money. Go to PILLmethod.com, ice10k.com, ice10k.com, and get your savings and earnings report today. Call us at 256-886-1867 and ask your questions. And let's get a hold of Jerome as well so that we can save money and do more for our families. Listen, folks, we've got some really good shows coming up. I want to talk to you about our shows coming up on Wednesday. On Wednesday, let me see here. Let me bring up our next 3 shows. On Wednesday, we're going to be talking about, did you overpay for your house? Did you overpay for your house? Let's talk about, because during the height of the pandemic and the interest rates were low, people went out and there was a bidding war. Some people actually overpaid for their house. We're going to show you how you don't have to be underwater on that house anymore. Let's get it so that you can get equity in that house you overpaid for. They're going to talk about that on Wednesday. On this coming Friday, we're going to be talking about mortgage modification scams. Mortgage modification scams, where people don't understand how a mortgage modification actually works, what the bank is doing to them, giving them huge mortgages, like 40-year mortgages, crazy interest rates. We talked to one who's got to save their house, the modification company put them into a 15% mortgage. Listen, folks, we're going to show you what to do about these things, and you don't have to worry about that. And here's what we're going to be talking about next Sunday. And you want to hear this. If you're trying to sell your house now, how would you like it so that you can guarantee getting cash offers for your house and close within 30 days? We're going to have an expert here talking to you about how to put your house out there so that you attract, all right, cash offers for your house like bees to honey. How would you like that? And you can bypass the realtor as well. All right. There are other people that can help you to buy a house other than a realtor, and you can guarantee the fact that you can get cash offers for your house. That's just another strategy we're going to be talking about next Sunday. You don't want to miss it. Thank you, everybody, for being here. Jerome, thank you for coming on stage. I also want to thank Michelle for her support as well. Folks, go ahead and subscribe to this channel. There's a whole lot of good information out there. Share it with your families. We're going to be right back here next week with good information, a masterclass every time we show up. All right? Take it easy, everybody. See ya on Wednesday. How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L. method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.